Good morning. Welcome. It is 6 o'clock on February 14th, Wednesday, Valentine's Day. Happy Valentine's Day, everyone. Yesterday, we had the market pull back, and then at the last half hour, we started trading back up. So what we want to see is whether or not that upward bullish momentum carried into this morning, or at least into the futures. And if it looks like it'll carry into this morning, and then does that actually mean that we're on our way up, if that's the case, or does it look like we're going to break down? So let's take a look at our futures and see what that looks like. Okay, and so we are up. Let's see, that is about 50 basis points on S&P, about a little over 50 basis points, maybe 60, 65 basis points on the NASDAQ. So we're definitely up this morning, and we're definitely up non-random. So it's looking like we'll probably have a green day. So we will probably have a close above yesterday's close. It doesn't mean that we're not guaranteed, though. We're not so far into it that it's a sure thing. So let's see how that's looking in the pre-markets. Okay. So I'm actually going to zoom out and take a somewhat longer view over the last 2 or 3 days. So we had highs over here on Monday, and then Tuesday was this gap down right here. So this area right here, right before the report, that's going to be a significant area. And you can tell I didn't add any new lines yesterday. All these purple lines came from before, when we've just been adding these lines on as we've seen those levels pop up. So we fell basically exactly from this purple line right here. So I'm going to mark this one a different color because it's going to be a more significant level over the rest of this week. And if we are opening higher, we did get this momentum upwards in the last half hour. It went mostly sideways over the post-market session. We did go higher, but then came back down. And then this morning in the pre-market session, we gapped up and started trading a little bit higher throughout the pre-market session. So that's probably going to carry forward into the open. But what we really want to see is to approach this blue line. And when we challenge this blue line, we want it to go through with momentum. We don't want it to pause right there. We don't want it to bounce off of it. We don't want to go up a little bit and then retrace. We want it to just go through. We want it to make it as if that line wasn't even there. If it just trades right through into that purple line up here and completely ignores this blue line, then that's a good sign that we will continue upwards. If we pause or struggle at all right here, then it's a question mark. So be very careful when you trade today. And if you go into any longs, the market could pause right here and it could actually pull back. It could become a bull trap. Everyone's thinking, oh yeah, we bounce off of the EMA 20, we're headed higher. We got this upward momentum in the last half hour that carried through into this session, but you could get trapped. So be very, very, very careful. I wouldn't be trading personally. I won't take any new longs to the upside unless I had a very specific strategy for it, unless I saw the market move through this level. And the other exception is if you take any hedges. Take hedges in the first hour or so if you need to add hedges to your account. But if you're going to take on any new long positions, I'd be very careful. If you're going to take any short positions, you don't have to be as careful, but you might wait for right here as well, because if we end up bouncing off of that level, then that's a really great time. So you'll just add that much more profit to your position if you allow it to trade up first then come down. Of course, individual stocks may not follow the overall market precisely, especially if you're trading a stock that's not correlated to the market or hasn't been correlated to the market lately. So if we, let's see if I can find a good example of that. I should just sort the other way. Let's do it. Sort the other way, and then look at the charts. Okay, so Paycom and Albemarle, great examples. Okay. This is negatively correlated to the market. The market was down yesterday. This is also down. Today, as we are opening, it is a little bit up, but what we are seeing is the market just barely pulled back from all-time highs, and then we've got Albemarle that's just been going down. So this is moving upwards with the open. Right here, we moved upwards over here. Albemarle's opening a tiny bit higher as well. But it's thin in the pre-market, so I wouldn't make too much of it. So during the market hours, though, we would just expect it to start dropping downwards. So you'll get a little more boom for your buck if you wait up here and then allow it to fall. So this is the example where it's a short opportunity that in the short term has been correlated to the market. So what I want actually is an example where it's not correlated to the market. I can try Paycom or ADM. I don't want to spend too much time on this. So we'll just see if we can find a quick example. FMC, maybe JD. All right, it doesn't look like I'm going to get a good example, but if I saw a stock that was going sideways or actually even down in the pre-market where the S&P went upwards, then I'd be okay with trading that short before I saw that bounce. But if it's looking like it's trading up in the same direction of the S&P 500, I would wait for a bounce off of that blue line. So on the surface, so far, it is looking like we're bouncing off of that EMA 20. But if we can't get over this high from yesterday, or that level where we started to drop from, which I think was like 499.50, or I have 499.51 right here, but 499.50. If we can't get beyond that today, maybe I'll draw a line just for today. I get a little messy in here though. 499.51. Okay. So if we can't get, basically, it looks like a little below the previous day low, or right at that psychological resistance. If we can't get beyond that today, then we are still in the sort of not so great territory. I don't want to call it bearish, but sideways. It would be the sideways chop territory. So it wouldn't be really bullish. It wouldn't be the time to just go all in on stocks, unless of course you're well hedged and you don't care. So just be careful, especially if you're day trading. You want to watch out for that blue line right there. If you're trading to the upside, then you want to see it carry through with momentum to beyond that level. And if you're going to day trade to downside, that's a really great place to watch and say, do we have trouble breaking above it? That'd be a great time to buy a put if we do. Okay, let's take a look at VIX. VIX is going to be very important to watch. I mentioned it yesterday in the aftermarket and mentioned that it could be a good hedge. So VIX is coming down this morning, which is not too surprising because of that, the expected move upwards from the pre-market. If we don't trade it all the way back down to, at the very least, these 12 to 13 levels, then we still have elevated volatility, which means that the market makers still aren't too confident. So what we really want to see is this VIX to keep on trading down. If I want to use the VIX as a hedge, though, then my expectation is, yeah, I might trade down, but I want to protect against a move upwards. So, hey, I might lose money. I'm okay with that. I'm going to size myself so that I'm okay with the amount of money that I lose if we go back down to 13 or 12. The great news is you're probably not going to go all the way down to 12. 12 would be way down here. So 12 would be a really conservative estimate. And we have a potential upside of yesterday's high was around 18. So those would be the ranges that I'm looking for. So we're at 14.44, call that 14 and a half. I have about 2.5 points to the downside, but I have 3.5 points to the upside. So just from that pure, just raw analysis, you're looking at a 1.5 to 1 ratio. And then if I translate that over to the options, I might get some really good reward risk ratios. So I might as well spend the rest of the time looking at that because there's not too much more to look at. Economic calendar, nothing today, nothing tomorrow. Friday, we'll get the PPI. If the PPI supports what we saw in the CPI, you could see further breakdown. If it's just kind of nothing or even to upside, I wouldn't expect it to have a huge impact on the market. Even into the downside, I wouldn't expect it to have a huge impact on the market unless we start bouncing from here. If we start bouncing from here and we start recovering today and tomorrow, and then the PPI hits and it's negative again, then that could send us downwards. But other than that, I don't see PPI having a big effect. We do have stocks reporting today and tomorrow with quite a number of them, and this is the heaviest. Next week will end the heavy earnings reporting. So we could have some effect from reports, but they're not huge market cap. Cisco is a larger one. And then yeah, but I would only say Cisco is a John Deere, little kind of big, but Cisco is the only really big one over the next couple of days. So I'm not really expecting earnings to have a big impact on the market. We're really just going to be looking at volatility bonds. If bonds start breaking down, so it's sitting right there at the MA90. MA90 or MA100 is what professionals will be looking at in the bond portions of their portfolios. So if we break below that MA90, that's going to be bad news for the major indices. So let's take a look at a VIX trade idea, hedge trade idea. And it could be a position, a normal position in your portfolio also, because we're sizing it so small that if you just want to throw it in there into your portfolio, it's not going to be a big deal because we want to size it such that if we lose, then it doesn't really matter. We'll go out, let's say it's Feb 14. Let's go out to April, give ourselves a little time because we don't know the exact timing. We are anticipating that maybe in the next 1 to 2 weeks, there could be a larger correction, and that's what we want to protect. So if I go and I buy a call because I'm expecting VIX or I'm protecting myself against a spike in the VIX, then I want to buy a call. And let's just try the at the money 14 and a half strike. I want to know that if it goes in the next couple of weeks, because that's my time frame, that my expectation is the risk that I'm concerned about is the breakdown of the indices over the next 2 weeks. So let's go 2 weeks out. That would be the end of, we might as well go to March 1st. And I want to see if we go to 18, how much does this make? We would go from about $2, let's call that $2.60 to be on the conservative side. And theoretically, we'd go to 4.79. So 4.79, that'd be $2.19. And then if we go down to 12, which is the extreme, right? It's really more realistically, if we go down, we probably hit the 12.5 or 13 level. But let's just be more conservative and say if we go down to 12, then we would theoretically lose $1.50. So it was 279 divided by 1.5. So it's almost a 2-to-1 reward risk ratio, which is really good. So the question is, am I okay with spending $260 with the potential in order to get $280 of protection? Am I happy with that? And if not, then maybe I want to go for something a little bit cheaper that might give me a little bit better potential. So let's just throw out there, we're expecting that, hey, it could spike maybe up to 18. So it would be a lot more risky for me to go up to this 18 level, but let's see how the reward risk ratio is and how much protection that gives me versus the price that I would pay. So I'd be paying about $1.50. And if we went down to 12, it would be theoretically priced at 46 cents. So let's say we lose about $1, so about $100 right here. And if we go up to 18, okay, we can make $1.40. Yeah, about $1.40. So obviously that's not as good of a reward risk ratio. I'd only be about a 1.5 to 1 versus a 1.86 to 1. But my $1.50 buys me $1.40 of protection versus my $2.50 buys me $2.80 of protection. So $2.80 divided by $2.50, 1.12 versus $1.50, $1.40. What we're saying here? Yeah, $1.40. $1.40 divided, 140 divided by $1.50. I did that wrong. It's less than 1. It's almost 1. It's less than 1. This was a little bit better than 1. So actually, the at the money provides me better protection in this case. So am I okay with spending $250? That would be the only question here, or $260. Is my portfolio, is $260 an appropriate size? And getting $280 of protection, is that an appropriate size for my portfolio? And I'm risking about $1.50. Is that right? If I remember correctly, it was about $1.50. It was about a 2-to-1. Yeah, so it's about right. So are we okay with that? And if it's too much, then we would be forced to go lower and accept something that does not have as good as protection, but it doesn't cost me as much. My alternative could be, hey, I don't want to go all the way out to April. Maybe I'll just go out to March. And then I would look at those again and say, okay, well, time-wise, I'm going to get hurt a little bit more, but maybe it does provide me better protection, and it's obviously much cheaper right here. So we would be doing that same analysis that we just did. Okay, so if you're not hedged, I suggest getting a hedge on. VIX is a good choice. QQQ directly on whatever index that you want to use is a good choice. VIX is probably going to give you a little bit more bang for your buck right now. and it's a indirect way, a less direct way of hedging. And so you just want to make sure that you size appropriately. But hedges are a great idea right now. I'm not saying that we're going to reverse trend. We're just saying that there's heightened risk of a reverse trend right now. But until we actually see it, we're going to maintain our view that the trend is up, and we came and we tested it. And so far, the signs are that we're going to bounce off of it and continue, but we want to hedge ourselves in case our momentum doesn't carry through and there's a bull trap and we start heading back down to our trend line and potentially break through it. So remember, hedge is just a protection. It's not a position. And the reason why we're hedging is because there is potential for that reversal, but we don't want to start positioning our entire portfolio for a change of trend. All we want to do is hedge. So it's already 6:22. So let's go ahead and prepare for the open, and I will see you guys in the aftermarket.